The bank's $600 billion secret. I'm your host, Steve Van Metre. Thanks for joining me today. In our lead story today, we're going to reveal the shocking truth behind the bank's $600 billion secret that they're hiding in plain sight. We're going to look at why the banks were incentivized to put themselves in a position to fail. But before we get to that, Jamie Dimon, the CEO of JP Chase, is now saying that more banks will fail, and we're going to look at why this is connected to the $600 billion secret. And could Schwab Bank be one of the next big banks to fail? Well, we'll take a look at what's going on with them and why they could be in big trouble. Let's over to CNBC, where he picked today's story up with a headline. Jamie Dimon issues warning on rates, says it will undress problems in the economy. And we're already starting to see signs of higher rates causing problems. And this is typically what we see in the late stages of a Federal Reserve hiking cycle. The next thing you know, there are banks, there are institutions, there are businesses, there are people that are not positioned to handle higher rates, and that their business model perhaps was entirely predicated on the fact that rates needed to stay low and go lower. But for the banks, this is becoming a severe problem that Jamie Dimon says is only going to get worse. People need to be prepared for the potential of higher rates for longer, he said. If and when that happens, it will undress problems in the economy for those who are too exposed to floating rates and for who are too exposed to refi risk, he said, referring to loans that reset at market rates. Those exposures will be multiple parts of the economy. Well, let's address the first one of higher rates for longer, because there's not a whole lot of evidence to support that. And so I'm not sure exactly why he's saying that, but we take a look at the yield curve here. We've got the 10-year Treasury yield in blue against the 10-year 2-year yield curve. So this is, again, when you take the 10-year yield, subtract the 2-year yield, we show that in red. And when you see an inversion, of course, that's when the red line falls below the horizontal black line, and then it steepens. Well, it suggests that rates are going to come down. This is called a bull steepener. So when you see an inversion, usually at some point that inversion turns positive and starts to steepen and rates decline. And you can see that here going into the early 90s soft recession, into the dot-com bubble, into the global financial crisis, going into the pandemic, and now we're starting to see signs of the early stages of a bull steepener, which should suggest that rates are not going to stay higher for longer, that they're actually going to come down. And there's further evidence of this as we take a look at the 10-year Treasury yield against the net percentage of domestic banks tightening standards for commercial industrial loans. Here we have the baseline for those tightening standards shown in green. So every time you see the red line move above that horizontal green line or stay above it, it means banks are tightening lending standards. So here again, you see going into the dot-com bubble, banks started tightening standards, and lo and behold, what do you see the 10-year Treasury yield do in blue? Well, it started to fall. You see that again going into the global financial crisis. We see tightening standards and yields fell. We see that in the pandemic, standards tightened, yields fell. Now we're seeing standards tighten and yields again in their early stages of decline, thus suggesting that, again, we're not sure what Dimon's motivation here is, but you might be able to guess. But of course, he also mentions in his piece, let's go back to this, about floating rate risk. And of course, if you're wondering what that is, maybe think back to the global financial crisis and what happened with all those people who had adjustable rate mortgages. Well, when the rate adjusted higher, their incomes weren't moving up enough because the economy slowed. They couldn't afford those higher payments. And next thing you know, we were into seeing delinquencies, eventually defaults, and then the whole system start to crater. And what Jamie's suggesting here is that, hey, there's a lot of people, not only businesses, consumers, banks, that are not positioned for when these floating rate loans or floating rates move higher and the rates on their loans ratchet up, and so too does their payment. Before its part, the biggest bank, again, JP Morgan here, by assets, studies how benchmark rates closer to 6% would impact the company. He said that flies against the market assumptions that the Federal Reserve being cutting rates in the back half of this year, reaching below 4%. He said all his bank's clients, he told all his bank's clients to prepare for the risk of higher rates. And so you may remember way back when there was another time that he told all of his customers and clients, hey, you, especially as hedge fund clients, you need to get ready for higher rates. And what happened is they started shorting the bond market at an even larger rate than they did before. And it turned out on the end that JP Morgan was heavily long the bond market, suggesting that perhaps he's looking to accumulate bonds here for the bank and needs a lot of bag holders to sign up. And of course, we note that we've seen data out recently that shows there are just massive short positions against the U.S. Treasury bond market as a market belief rates will go higher. Jamie Dimon now saying that's going to happen. But what do you think? Do you think that rates are going up or down? But let's take a look at this next chart, which suggests that the Fed is going to be lowering rates in the back half of this year, and probably at a rather dramatic rate. Here we're looking at the federal funds rate in blue against the 10-year 3-month yield curve, shown again the horizontal black line where the curve is inverted and then steepens from there. And I've noted, at the point you see these little yellow marks where I've noted where you see the inversion, and notably you tend to see peak federal funds rate, and you see that again going into the late 80s. You see it here in the early 2000s. You see it going into the global financial crisis, and a steep inversion leads to a Fed pause. You see it going into the pandemic, and now is one of the only times that we have data on that shows the Fed is kind of bucking their normal trend of looking at the yield curve. Of course, we can note that Fed Chair Powell has said repeatedly that even though he cares about the yield curve, he continues to rewrite what he cares about to the point where he's not suggesting that he's looking at it at all. Meanwhile, the yield curve is screaming that this inversion is going to lead to a massive bull steepener and force the Fed to cut rates. And of course, that's what we're going to likely see at least in the second half of this year, if not perhaps sooner. And now would be the time to fix it, Dimon says. He says, do not put yourself in a position where that risk is excessive for your company, your business, or your investment pools. Again, speaking out to people to say, look, you need to short the bond market here because I probably want to buy all of the opposite position on that. He said higher rates would put additional pressure on mid-sized banks like First Republic that were damaged in last month's tumult, and the value of their bond holdings moves lower as rates rise, as First Republic is being advised by J.P. Morgan and Lazard. He expects regional banks to post pretty good numbers next week, but there's a risk of additional bank failures, and you could definitely see that case if rates continue to rise and there's deposit flight, which is kind of what he's suggesting would happen, would put stress on a number of other marginal banks and would ultimately lead to their failure. But the real question we should be asking is, why did the banks do what they did? Why did they accumulate this large $600 billion position that's now sitting on historic unrealized losses? Well, let's take a look at the truth, because it may be too good to be true. Bank bosses are hiding $600 billion in unrealized losses to keep their mega bonuses. Here's why portfolio securities should be marked to market. This from Fortune magazine. As Silicon Valley Bank failed because it invested too much in long-term bonds that lost value when interest rates went up. And that's what our accounting rules encourage banks to do. As a consequence, U.S. banks, including some of America's leading banks, are estimated to have over $600 billion in unrecognized losses on their underwater securities in their books. And so again, the question comes is, why did they do it? Was it just a simple fact of there was all this pandemic money that hit the banking system? They had nothing else to do with it because people didn't want to borrow. They didn't need to borrow. So they went out and bought a bunch of treasury securities. Is it just as innocent as that? Or was there a motivation behind which treasury securities they bought? Well, that's the truth. Therefore, in the short run, management gets bigger bonuses by buying long-term securities. By buying long-term securities that paid an average of 1.5% instead of safe one-year T-bills, the bank more than doubled Silicon Valley's 2022 income and its return on equity. With this system, the extra benefits to CEO Becker and CFO Beck were in the millions. And of course, we know what then followed afterwards. Of course, as rates rose, Silicon Valley Bank and others started to implode because of these unrealized losses. And so now what we're starting to find out is the banks actually may have had a choice, but went out and looked for these higher yielding securities, which then were much higher than, of course, T-bill rates, and used it to line their own pockets. Silicon Valley Bank already had about $7 billion in market value losses by March 31st of last year. Had it sold any of underwater securities, which many people have wondered why it didn't, to shorten the average maturity of its holding and thereby reduce its downside if rates continue to go up, it would have had to recognize that $7 billion loss. And if it recognized that loss, get this, it would have lost almost half of its equity capital of $16 billion and would have been in danger of failing. Instead, it chose to roll the dice, and of course we know the outcome already of what happened, but what you're starting to see is perhaps greed from bank management led them to building out the portfolios that they did. What is the excuse for reporting bonds at value that are not real? Bankers in advance for a few reasons. First, they say the interest rate risks of assets like bonds have to be managed in relation to the interest rate risk of the other side of their balance sheet or liabilities, which are primarily deposits. Now, keep in mind, deposits typically stay on bank balance sheets at the very least 3 years, but typically somewhere around 5 to 7 years, depending on if it's a corporate or consumer deposit. So when you look at what a bank is going to do, it's going to go build out a portfolio that's going to have an average duration or maturity of somewhere around 5 years, with the idea that these deposits just aren't actually going to leave any time soon. But in a rising interest rate market, as we've learned, well, that time scale goes down considerably. Interest rates going up may cause assets to decline in value, they say. But interest rates going up may, on the other hand, cause the effective price of deposits to go down. If managed correctly, bankers say the two should offset each other. But, well, the reality is we didn't see that happen at all. And instead, we get to this picture here where we see the unrealized gains or losses shown in the negative side on investment security. And we can see there are periods in time going back to 2008 where banks were upside down a little bit on their portfolio as the Fed was gradually raising rates, and that changed as the Fed cut rates, and then they were positive on their portfolio. Then they were negative a little bit in 2018. Of course, we were toward the end of that Fed hiking cycle, and as the Fed cut, they got into the plus, and now we're into the negative here. So you go back and look at what actually happened, and you may recall former Treasury Secretary Steve Mnuchin, when during the pandemic, he issued a boatload of T-bills, and then the Fed turned around and says, hey, we're going to do a whole bunch of quantitative easing. Of course, what we know is the Fed did quantitative easing mostly in notes and bonds. They really didn't buy that many T-bills. So what did in turn, the Treasury, needing to feed the Fed's big appetite for notes and bonds, had to then refi a lot of these bills into notes and bonds so the Fed can buy them. But what the banks should have done, as we now know, is they should have taken a lion's share of those T-bills. The Fed should have stepped back and said, look, we'll do some QE as we see this thing unfold, but you have to remember, a lot of this pandemic stimulus money didn't come immediately and was paid out over time, so the banks had to react over time. Meanwhile, the Fed was just vacuuming up all these notes and bonds, and of course the Treasury had no question, no doubt of what they had to do was roll again these T-bills into notes and bonds to feed the big Fed machine. But the banks, as we now know, should have bought T-bills, but the reason they didn't was management wanted big bonuses. So what do you think about that? Love to get your feedback. Do you think the management should have been looking out for their customers or their own pocketbook? Because now the next question is, could this lead to a failure of one of the biggest banks, not brokerage firms, not to be confused with Schwab Brokerage, but could Schwab Bank be on the list of the next banks to fail? Let's take a look. Schwab faces fresh risk in the zero-fee landscape that it's shaped. Now, it's going to report its earnings on Monday, but I want you to keep in mind as you think about this, we may be in the calm of the middle of this banking storm as we head into a recession. So the situation for Schwab and other banks may look okay today. The question is, in the months and quarters to come, will it get worse? As Charles Schwab stunned Wall Street in 2019 by slashing commissions to zero, forcing competitors to adapt. But now that amount has amounted to a big bet that its bank, again, not the brokerage firm, the bank, rather than its brokerage, which keep driving profits. For a while, it worked. The pandemic hit, interest rates were pinned near lows, and Schwab raked in billions in fees that had forsaken were offset by what the company earned from its banking operation. Now, Schwab, the biggest publicly traded U.S. brokerage, faces one of the most painful moments in its 50-year history. After a rapid surge in interest rates, deposits sank while unrealized losses swell. The stock plunged by 33% in March, its worst month since 1987. So the question then becomes, what was the market seeing in relation to what's going on with Schwab? Was it just a matter that was upside down on its balance sheet? Let's dig a little deeper. If they decline too far, Schwab could eventually be forced to sell securities at a loss, but the CEO says that this is not going to happen, and he issued 2 joint statements in recent weeks to reassure investors there's a near zero chance of that, and they touted $53 billion of client assets that arrived in March, the second largest for that month on record. So money flowed into Schwab kind of as support, but the question is, underneath all of that, what's going on with Schwab? Take a look at this. To shore up its business in the short term, Schwab has been relying on loans. The firm said it had $100 billion in cash flow, more than $300 billion available from the Federal Home Loan Bank. It has already drawn from that pool, if you can imagine. They became the largest borrower from its local branch, the Dallas Federal Home Loan Bank, in 2022, according to filings, and they borrowed $12.4 billion from it last year, an additional $13 billion so far this year. And against that backdrop, Schwab continued to reward its shareholders by increasing dividends and repurchasing shares, kind of putting into question, is Schwab worried more about its investors than it is its depositors and its business model? It's betting that perhaps this crisis is over and that the Fed will be cutting rates soon. But if we have a recession and the Fed is slow to respond, as they usually are, Schwab could face, at least the banking side, more deposit outflow, putting their big model in stress, and as Jamie Dimon said, could lead to more bank failures, all because management of these banks were greedy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.